All right, welcome everybody to the second quarter economic update. And we're going to be hosting this event on a quarterly basis on the final Wednesday of each new quarter. So July, October, January, and April. And so this is our agenda here. What we're going to go over is where have we been and where are we now? So the US economy, and cover some touch points here, talk about the bond markets as well as the global economy, and then talk about where are we going. So in terms of positioning portfolios, are we positioning towards growth versus value? Well, you can see large versus small, stocks and bonds. And so we'll cover a number of areas within international and the bond markets here as well. And then we'll wrap up with some historical charts covering where we are, and then on a looking forward basis. Okay, so first we are wanting to start with inflation. So we're all experiencing inflation, and really everywhere. So gasoline is the number one over the last year. Gas prices have risen almost 50%. Additionally, we have natural gas. So natural gas has risen by 30%. We've all seen used cars, and of course at the grocery store, groceries going up 10%. So overall, over the past year, inflation has risen by 8.58%. And one of the things that we're seeing in the economy as well is that we have very low unemployment and above average wage growth. So unemployment, the 50-year average is with this gray chart here. And so the average unemployment rate at 6.2, what we have right now is 3.6. So all of the jobs that were lost during the pandemic here have been recovered, which is 21 million jobs. Yep. And so all of the jobs have recovered and are now above. We're having a slight problem with Brian attending, so that's why I'm looking at my text there. Hopefully he'll be able to join as a participant. So I'm going to keep working through here. And so the other piece we have is wage growth. So average wage growth historically at 4%, and what we're seeing right now is 6.5%. The rub, however, is that inflation is growing faster than wage growth. So people don't exactly feel like they're getting ahead per se. Now we have labor demand. So there are over 10 million jobs available in our country, and there are almost 2 times as many jobs available as people even looking for jobs. All right, Ryan, excellent. So in terms of the demand for labor in this trend, in terms of jobs increasing, in terms of wage increase and unemployment, we don't see this trend really going anywhere. You can see here layoffs are really quite low. Employers are happy to keep their employees. This is an interesting piece here, which is people are leaving and changing their jobs. Additionally, the number of small business applications since the pandemic is at a high point. So a combination of sort of people following their passions and starting new businesses, which is along the lines of entrepreneurship in our country, which I would say is a competitive advantage to our sort of culture. But we're also finding that there are a tremendous amount of jobs available. Okay, next want to cover some consumer finance data points, and mainly this section of the chart down here. So historically, we've had a country where people spend more than they make and they accumulate credit card debt to the tune of around 5% of their budget in terms of revolving debt. Well, during the pandemic, we had all this stimulus. So what you see here is people accumulated cash during the pandemic, and we had this stimulative decisions. Even though people's expenses went down, we were staying home. We basically had grocery bills and utilities. And so we've been experiencing inflation, which is people putting that money to work. The definition of inflation is more dollars chasing the same or fewer goods and services. So out of the $2.2 trillion of stimulus, about a 0.24 of it has been spent. So the excess cash sitting on balance sheets for consumers is over $2 trillion, which still hasn't been deployed into the economy yet. Okay, shifting gears to the second piece of the agenda in terms of interest rates. So today, again, the Federal Reserve is meeting today. They're going to announce their interest rate hike, anywhere from, 0.5% to 1%. It may end up being 0.75. So you see here, what this chart is showing you is the expectations of where interest rates will rise to, whether it be by the end of the year, and even some of this. FOMC stands for Federal Open Market Committee. So these are the people who meet, are thinking that interest rates may rise into next year and beyond. And the green sort of dot plot are the market expectations, which you notice goes down. What that means is, well, I'm sure you've heard on the news that there's a recession coming at some point. Recession is not something to be overly afraid of or concerned about. It's just part of the business cycle and the economic cycle. But what you're seeing here is that the expectations that interest rates will rise to tamp down inflation, only for interest rates to decrease in the future when the impending or future recession comes. So that's sort of an interesting thought process in terms of looking at the future. Okay, the next piece that we wanted to go over is who owns all the government bonds that the US sells. And there's this sort of false dialogue that China has something over our heads because they own our government bonds. And that is a false narrative completely. Additionally, China does not own the most government treasuries of any foreign government. So Japan, you can see here, they own just under $1.3 trillion of US treasuries, whereas China owns, just under $1.1 trillion. These are other foreign governments here, and the rest of the globe makes up the 41%. But when you factor in the whole thing together, the percentage of US treasuries owned by foreigners is 38%. So most of the US treasuries are owned by US corporations, US banks, and individuals. So this is something that we wanted to highlight for you here.
Yeah, and just one thing is to make sure the 14% of China is actually 14% of 38%. So just make sure that folks understand it's not 14% overall. It's actually 14% subsection of that 38% that's owned by non-US entities. Yeah.
Beautiful. So additionally, we wanted to cover the federal budget and some federal finances. And so there can be heartburn around the fact that we sell a lot of bonds, and it is a function of our budgeting that we are borrowing around $1 trillion a year in terms of funding our government. the question is, what does it cost us to do that? What is the interest payment, the mortgage, so to speak, for the US government? And that number is 7%. So it cost us 7% to offer all these bonds in order to run the rest of the government. So in terms of budgeting and finance, I want to share with you that you don't need to feel some of these looming concerns that occasionally we will hear in terms of the structure of how we run our country. Okay. Next, we wanted to go over, similarly in the context of bonds, the fact that even in the riskiest bonds, which are high yield bonds, companies that take on the most risk and are needing to borrow in order to grow, evaluating their default rate, meaning they can't pay the notes and they're not intending to pay the notes. The current default rate on the riskiest bonds in the bond market is 0.72%. You see that represented all the way down here. The average long run at 3.6. So what this is saying is that the state of the riskiest corporations in the US is also quite strong. Now, interest rates are rising, so they may shift their risk perspective in terms of how they go about growing, but their current state of growth or state of borrowing to grow is healthy. Okay. Shifting gears now. So we talked about the US economy, we talked about the bond market. Now we're going to cover some pieces on the global economy. This is a sort of a heat map of activity. You see the overall globe here in green, and then broken down between manufacturing and services. On the left-hand side here, we have the developed world, and then we have emerging markets. The only two areas of the globe that are not currently growing would be China, in part because they have the zero COVID policy and had a lot of shutdowns, so the sort of self-inflicted slowdown, and then Russia for obvious reasons in terms of the Ukraine war. And so when you look at, and we already covered the US here, but when you look at the rest of the developed international areas, they're all over 50. It's not a percentage, it's just a metric of growth. So anything over 50 is a growing economy. So the world is still growing, but there are headwinds, there are issues. So specifically diving in further, this Ukraine war. So how does the war influence inflation both in Europe and in the US? And we put this chart in here to provide more context. One of the things we all learned out of this war is that Ukraine produces a lot of corn here, and they produce a lot of wheat. And with Russia's bad behavior, what do they contribute? What are they bringing to the table, so to speak, in terms of their natural resources? Natural gas, 17%, and then crude oil here, 12%. So Europe is experiencing inflation just the same way we are. And some of you may have heard on the news earlier this week about the Nord Stream pipeline, which was shut down for maintenance and is now running at a 20% capacity that it was previously. And Brian and I were talking about that earlier this week. So Germany, other EU countries are kind of scrambling to figure how are they going to store natural gas and how are they going to plan and prepare for the winter. So that's part of the dialogue that's happening around the latest update with Russia and their natural gas. And then the other thing is that Russia also is, Ukraine was saying that they're going to start their exports again, and then Russia's strategically attacking their ports. So it's still a mess and still ongoing. Okay, so that's where we are now. On a moving forward basis, the question is, where are we now? And then how are we considering things moving forward? So this is a chart from Fidelity. It's showing China here coming out of their recession. It's showing the UK and the Eurozone ahead of us in sort of the late cycle of their economic growth, economic cycle, ahead of us going into a recession on their own part. And then here is the US and Canada, still in the mid-cycle of economic growth: Brazil, Mexico, Australia, Japan, Korea, and India. So what's on the agenda is like, how are we planning and dealing with being in a late cycle of the economy and heading into recession? So considering the difference between large companies and small companies, we've been migrating towards larger companies. Naturally, because with rising interest rates, larger companies are better positioned to deal with the higher expense of that interest. And then in terms of growth versus value, we're migrating more towards value, because based on the late stage of the economic cycle, value is more favorable than growth. And then the other piece that we factor in is, what percentage of equities do we want to have in each particular model, and what percentage of bonds? And so bonds are like shocks on the car. So we've been increasing our bond exposure, preempting the recession. So thinking sort of 2 to 3 chess moves ahead, putting those pieces in place. Brian, did I leave anything out in that area in terms of and then so I guess the other piece that I wanted to share is, okay, what happens when we move into the recession? So it'll come eventually. Some of those pieces change. So for example, small caps lead out of a recession. So when we're eventually in a recession, which we don't 6 months, 12 months, 18 months, we would then shift towards small cap, because we know that relationship exists with small caps leading out of a recession. So I thought I would share that sort of highlight in terms of how things are moving and thinking 2 to 3 chess.
And as well, to add to what Chris says, like in late and then particularly into recession, regardless of how long or how shallow or deep it may be, tend to get, we were shifting more towards looking more at defensive sectors. So you're looking at healthcare, consumer staples, utilities, as well as dividend payers. So it kind of goes along the value theme, in addition to, like Chris mentioned, looking at more of the larger cap companies versus smaller caps.
Beautiful. Okay. This is Fidelity is highlighting further some of the characteristics of the economy in the late cycle and into the recession. So they're also saying that it's not, even though we see sometimes in our minds we see these cycles, well, Brian, you said it perfectly. It's like, we don't know how long a recession will be. We don't know how long we'll be in the late cycle. But with rising interest rates, we're going to see, the pace of growth to moderate a bit. Here again, the Fed's tightening, only for them to turn around and ease again, like we saw in that JP Morgan chart, when the time comes. So I guess the highlight here is we're aware of this. We're talking and analyzing this on an ongoing basis. So how does inflation affect the part of the portfolios in these different stages? And so we are, of course, in a high inflation time. And so commodities, that's what we're seeing now. The high natural gas prices, high oil prices. And we do have some exposure there because we see that trend. And then the US equities in a recession, yes, we'll see some of that. Negative return we've had a bear market. We'll talk more about where we are now, and what we could expect for the second half of the year. But when the recession comes, we may see some more of that longer term. The reason you see this sort of dip here with investment grade bonds is because of rising interest rates. So we have a chart on this, but if you imagine a seesaw and you have interest rates on one side and bond values on the other, as interest rates rise, bond values come under pressure, but you want those bond positions because when you see equities decline, those bonds act as a buoy in terms of having what's called negative correlation. So we'll talk more about that.
And then on the right, as Chris mentioned earlier, we're trying to think a step or two ahead, in the sense that we're in the late stage now, but going into a recession, you'll see in the high inflation environment where the investment grade bonds start pivoting, going from a negative average real return to a positive real return. So as Chris mentioned, we're trying to buy low, transition to bonds, anticipation of being in some level of recession. And then as projected, the Fed likely lowering rates at some point in 2023, 2024.
Thank you. Okay. This is a bit of a busy chart. So what I want to do is decipher this for you. So we are in a rising interest rate environment. That is the gray bars. What you see, there's a lot of negative numbers for certain subsections of the bond market. So again, we're still talking about bonds. But what you also find is that there are bonds that have positive returns. So leveraged loans, we have a focus point here, asset-based securities, US high yield. So we covered that earlier in terms of the low default rate. Convertibles, we don't focus much on because they function like a bond, but they act like an equity. So it doesn't actually reduce risk in the portfolio. And then what you have up here is 2-year US treasuries. And so we look at these subsections of the bond market to decide what makes it into the portfolio and for what reasons, and what do we deliberately not include in the portfolio itself. Okay. And so here's the yield curve. So of course, interest rates have been rising, and what you see with this gray chart is where interest rates were at the end of last year. And here, this yield curve is just naturally rising. And then the background, sort of this gray area or shading, shows the past 10 years. So we are expecting interest rates to rise further. And, in general, it's not a surprise. But I wanted to just show you also how you see this rising here, and then you get sort of diminishing returns. So this is the length of the bond in terms of years. So you would never really want to own a 30-year bond if it's going to pay less than a 20-year bond. And there's another chart just showing why. So there's some decision making here in terms of where do we want to sit on the yield curve itself. So that's part of what we do in the background on your behalf. And so this visual highlights further. So the name for that is called duration. So you can think of it like a CD, a 1-year CD, a 3-year CD, a 5-year CD. And for each 1% increase in interest rates, the equivalent of the length of your duration, so a 3-year duration, translates to a negative 3%, that seesaw relationship. A 5-year duration, -5. So for people who we do not have 20-year or 30-year duration bonds. Those people who don't know better otherwise are going to see significant negative returns in their portfolios. And because the further you sit away from the fulcrum, the more you're going to be impacted. So we deliberately sit closer to the center point. Okay. Now we wanted to cover a few pieces on international. So that was a piece about the bond market. International valuations are very, very attractive. So this is the price to earnings ratio and the discount versus the US. The only piece about this that I would also highlight is that this trend has been in place for about 10 years. So you see this coming down. So, Brian and I, we participate on these calls on an ongoing basis, and some of the sort of talking heads and economists highlight this point. It's like international's looking good, international's looking good. Well, that conversation's been in place for about 10 years. But there are some additional charts that we'll show you that would highlight that there's good reason to have an allocation to international, but we have a lower, and we started that in the beginning of the year because they're further ahead than we are in the economic cycle. We are on average underweighted towards international versus US. And then the other piece that Brian highlighted is about dividends. So not only is international looks attractive in terms of buy low, sell high, they also have very healthy dividends that the companies themselves are paying. And that's sort of an overlay in terms of our analysis and dialogue that Brian and I are having and have on an ongoing basis. And so this chart from Fidelity is talking about the emerging markets. And the diamond here is the last 20 years. So you see China's had, tremendous growth over the last 20 years. And some of the more developed international doesn't have, they're not growing by as much as the emerging markets. And so the emerging markets represented in blue here. The highlight here is we also maintain exposure to emerging markets, and for good reason, because over time, long term, the emerging markets is going to become a greater and greater part of the global economy. And so here's another reason why. So the US has outperformed. This is a sort of a separate chart. And so you're seeing we have charts from Fidelity and JP Morgan and all these different companies. First Trust, we haven't gotten one yet, but we have a few coming. And so JP Morgan's highlighting, yes, the US has been in favor for the last almost 15 years, but there are periods of time, 7 years here, 6 years here, lower frequency here, but there are times when international, and the EAFE stands for Europe and the Far East, does outperform the US. And so there's good reason for us to maintain some exposure to international. And that's why we do that. Okay, so now in terms of our agenda, we're talking about where have we been, where are we now? These are some historical charts covering just historical information to be aware of as it relates to on a looking forward basis. There's a lot of fear, there's a lot of anxiety and consternation because of inflation, because of the market correction. And so these charts are meant to give you data points as opposed to some of the feelings that we get from the messaging that comes through from time to time. So we are in fact in a bear market, and what the definition of that, or a correction, is a negative 20% return from the S&P 500. And that happens once on average every 6 years. Just to cover a few additional points, a correction of 15% typically happens every 3 years. 10% happens every year. We have a few additional charts that we'll cover, and 3 corrections of 5% every year. Well, what do we get as a result in return? An average return of 8%. If we were to evaluate the S&P 500 batting average in terms of a sports analogy or a metric, 73, just under 74% of the time, we're in positive territory, given tolerating and putting up with the historical trends. And so this is a chart from JP Morgan. And so some of you have probably seen this chart before. We've covered it in our ongoing planning meetings. These red dots are the intra-year declines. So the S&P 500 will lose money or will have some negative returns every year. We just don't know when it's going to happen. And if we only looked on a calendar year and just measured the results from January 1st to December 31st, the gray bar chart is what you see. And so just going back, for example, here's the financial crisis where things went poorly, or excuse me, this is tech. This is the early 2000s. We had 3 years in a row of negative results. The financial crisis is here. Even though this was 18 months, we only had 1 year of actual negative returns. And then the pandemic is here, 2020. And so even though we experienced 30% decline in 30 days during the pandemic, this was March of 2020, we made all of that back and then some. And so the other piece is that we've had a 6 months or 7 months since the November high. We saw negative 24%. And then on June 30th, we ended at negative 21. So Brian and I, we feel optimistic that the second half of the year is going to be better than the first half of the year. And so we'll see where we end up. But the historical trend would say 32 out of 42 years, we end up in the positive. Kind of hammering the home that same theme. This is a First Trust chart that highlights, I guess where I'm trying to go with this is that when we lose money, it is twice as painful as when we make money in our portfolio. So when the market's going up, we feel about the same or maybe a little better. And when it's going down, we feel way worse. And so when you look at down 21 to 28, this is all the way back to 1926. There's 3 of them here. So 2002, 74, and 1930, down 28, 2008, 31, and 37. So some of the Great Depression. So there are sort of 6 total here. When you look at up 28%, it's actually the most, more than any other factor. So sort of sharing with you, and then of course, if you look at 21 to 28, still significantly more than double that the 3 that are here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 4 times as frequently as this area here. So this is giving you the 96-year average at 10.5, but sort of separating it in the awful feelings and the good to slightly better feelings. First Trust again is breaking this down for us. This is sort of a small, let me zoom in here. So how often are we positive, making money in the bull, and how often are we losing money? And it's just sort of showing you that this blue section is a lot more prevalent than these yellow parts here. So won't go too in depth, but I think this is a helpful visual. Okay, this is a Fidelity chart. Let me go down, zoom out a little bit. Okay, so this is tied to inflation. So the S&P 500, the forward year return since 1958, so including the inflation from the late 70s and early 80s, when you look at 3 months, 6 months, and a 1 year, they're all positive. So this is just giving you the context of why we feel confident about the second half of this year and even going into next year, and then working through the recession whenever it comes. The other pieces, we have an election in the fall, so a midterm election. The 12-month period following a midterm election from 1950 to 2019, the last midterm election, 15.1% in terms of the S&P 500. So reassuring data points here. One of the things we commented on is the consternation, the frustration, the anxiety. So another way of saying that is consumer sentiment and the stock market. So this is US and we have international next. US consumer sentiment is low, and these low points here give you the historical return. So low point, historical return 43, or 12-month average following. Low point 15.4, low point 22.5, 14, 32, 29, 20, 22. So historically, when you have low consumer confidence like we're having now, it can translate to positive results. We measure this from a European perspective. European consumer sentiment low, previous lows 35, 14, 44, 22. So there's a case again for maintaining our exposure to the international markets, but still underallocated to where we've been in the past. Okay, as we wrap up here, please feel free to type any questions into the Q&A. We'll cover any of that. If we don't have any questions, we'll maybe wrap up early, but feel free to type any questions into the Q&A so we can make sure that we cover anything that may have been on your mind or queued that we haven't answered yet. Okay, so in terms of our last section here of the historical charts, we wanted to cover volatility. So volatility being a 1% move up or a 1% move down. The average on an annual basis is 62. And so you may be feeling those gyrations, and that feeling is accurate because we've had 63 days already in the first half of the year. So we're already above average and we're just barely slightly past the midpoint. So of course, here's the pandemic 2020. And, we've asked people in our ongoing planning meetings, how does this time feel compared to the pandemic? And it just feels different. During the pandemic, our worlds were totally reoriented. So the fact that we had this much volatility, people didn't notice as much. Now that we're coming out of the pandemic and we're having inflation, people are just noticing more. So we're wanting to sort of confirm for you that yes, what you're feeling is valid. But in terms of influencing your behavior, these are some other sort of data points to consider. This is a chart from Fidelity that shares with you if a person invested $100,000 in the S&P 500 in 1995 and just did nothing. By the end of February, that portfolio value would be $951,000. In all of those years, if the person missed the 5 best days, just literally days, the portfolio value is $590,000. If they missed the 10 best days, the portfolio value is $435,000. So significant decline in portfolio value, just, trying to, go with some sort of like feeling. It's like in terms of fear in general. And so our last chart here from First Trust gives you some of those statistical numbers as well. So on any given day, you have a 53% likelihood of making money. Any given year, 77%. And then on a 10-year basis, so into your retirement, through your retirement, 97% likelihood of success. So you can have confidence in your long-term financial plan, and all of the data points that we use in our presentation meetings and ongoing planning meetings to give you that confidence that you won't run out of money. This is some of that supporting data. And we share with our retirees, Brian and I, we need to sleep too. So we use these tools to design your retirement income to give you confidence that you're not going to run out of money. And we use that data to show you those metrics. So this is our disclosure document that compliance requires us to put in here. And so this is really the presentation. I actually thought I had too many slides, but it looks like we covered it all. We have about 20 minutes budgeted. I'm not going to extend the presentation necessarily if we don't have any Q&A. So feel free to email or excuse me, type anything in here. So we have one. You can repeat the interest rate chart towards the beginning. It would be helpful. Thanks a lot. So, okay, so let's go back to interest rates. Interest rates, let me go here. So the Federal Reserve and interest rates. This is going back to the 2000s. So in the beginning of 2000, that's when we had this basically tech meltdown, rising interest rates. Here, this was, so the last time we saw rising interest rates, and thank you, actually, I wanted to comment about high yield savings. So the last time we saw rising interest rates was here 2016 to into 2019. Even at this time, we were talking to our clients about having high yield savings accounts. Traditional banking, Chase Bank, Wells Fargo, Bank of America, those interest rates are tremendously low in checking and savings. And so if you are leveraging your cash by having an online, a high yield savings account, we're starting to see those numbers increase. We use a website called bankrate.com where you can, if you have any questions or want a suggestion about opening a high yield savings account to make more money on your cash, just send me an email and I can reply with some options to consider. And so interest rates are likely going to rise again today. It's just, I only say likely so that I'm, putting my accuracy in there. It's really a question of, are they going to rise by 0.25%, 0.5%, 0.75? They were, what was on the news, they were even flirting with a full 1 percentage point raise. And you can see, they had sort of a similar, there was a 0.25 earlier, 0.75 the last time. The Federal Reserve meets every 6 weeks. Brian and I track this, so we know exactly when the next meeting is. But what that translates to is 10 meetings per year. So there will be, 4 to 5 more meetings and likely interest rate increases at each one. They've talked a little bit about what they're calling a start and stop and start approach. That's sort of up for debate. If interest rates take a pause for one meeting and then they increase again, we'll see. It's been, like you can see here, it's been done in the past. We'll see what this Federal Reserve decides to do. And so the expectation is that interest rates will rise into next year and possibly into 2024, only for them to be lowered in the future. It's like dry powder. You're sort of building up this interest rate in order to lower it, so you have dry powder to use in order to re-stimulate the economy through the recession.
Yeah. And just kind of a comment on that, we've got today's announcement that's going to happen, I guess, about 15 minutes. But the next meeting of the Fed, which will be in September, we've got 2 releases of CPI in between there. So there's going to be it'll be some interesting to see what happens in the next 6 weeks after today, because we've got a little bit more data that's going to be coming out in between meetings. So we'll see what happens there as far as with inflation and all the other factors that go into the decision.
Question was, how do you miss the best days? The way you miss the best days is by being in cash. So let me go back to this Fidelity chart here. Missing the best days is sort of feeding into the sort of CNBC should I own this? Should I own this? Sort of that kind of day trading trend that we've seen in the last 10 to 15 years, sort of gamifying risk management. And so that's how it gets missed, is that people sell their position, whatever it may be, and go into cash in the idea that there'll be some lower price at some point in the future, and then they'll make that sort of second right decision to buy when it's low and go from there. So that's the definition of missing the best 5 days, is having your position in cash otherwise.
And in some cases, in addition to the GameFi, because market timing that Chris, some people just get, to the point of talked about the 61 days of 1% moves, people get nervous. And that's why, even though it is very painful and a lot of anxiety and nervousness comes about, regardless of your risk profile, try to avoid the temptation of like, I want to go all cash, or, there's investors that get to the point of breaking point and they're just like, okay, I'm just going to sell everything. So that's also why I want to try to kind of make sure folks understand is like, you could have a COVID situation, people get out of the market, and then all of a sudden, before they know it, the market's turned the opposite way to a greater extent on the rise. And then meanwhile, they've sat in cash. So that's another way that folks miss the best days, is just the plain nervousness and making sure folks understand that this nest egg is for to achieve your goals and what you want to do over a longer period, not just a day or a week, or that anxiety may be able to build up.
And sort of Brian's point, this is the financial crisis here, 2007, 2008, 2009. So that was 18 months. So it started at the end of 2017. You see this negative 10% came at the end of 2017, but the market still ended up 4% on the year. 2007. 2008 is here, awful year. But what happened was at the end of 2008, there was this 11% rally. So people had this sort of like moment of hope. And then going into 2009, it went down 28%. So this was, the term is called capitulation, where it's like people just can't put up with it anymore. But what happened, March 9th of 2009, negative 28%. In the 9 months from March 9th of 2009, or March to December 31st, it made up the 28%, and then it ended up 23%. So the market did 51% in 9 months. That happened during COVID. So 2020, COVID happens in there again, March again, 34% in 30 days. March of 2020, we go to the end of the year, 34% back, and another 16 on top of it. So 2020 ended up being a good year, despite the fact that it was painful in the process. But here's another 50% increase in 9 months alone. So when you see some of these numbers, it can be like really almost too good to be true, in the sense it's not, it's just too good to be risk-free. There's risk. And so what Brian and I do, we manage the risk on your behalf, and we go through this process every quarter. And so similarly, we're hosting this event every quarter to give you these data points, so that on a 1 hour basis, every 3 months, we can present the data to you, and you can have some of that peace of mind, because the news media has no interest in you feeling less stress. It's that stress that drives their advertising and drives engagement, which is unhelpful. Talk about mental health. It's like not good for our mental health, but it drives profit and engagement, unfortunately. Next comment: during recession times, some say cash is king. Do you agree with the statement? It is. I would sort of refine the statement to say it has to do with how, for me, it's more of savings. So if you're in a savings mode, or you're in building your portfolio, and you're making a regular deposit, yes, cash is king because you're able to take some of your cash and put it into your portfolio. But going into a recession, I wouldn't necessarily take your portfolio, try to convert a portion of it or all of it, definitely not, into cash just to go back in, because we don't know what the future holds. And the data would suggest if you have cash from earned income, sure. Or if you wanted to save less, the idea, leading into recession, then you'll save more when you see that dip. That can be part of the strategy, and that's sort of a instinctual thing, a gut feeling, if you will. But there's just a lot of energy around that, and of course we have systematic deposits for a lot of the families that are saving and planning for their retirement. So it's just a matter of, okay, at what level of saving do people feel comfortable with? And even like now, like we're here in this area. Now is a very good time to increase some of that systematic saving if you have cash to do so.
Yeah, and then just to add to Chris's point, a good minute of the time, declaring a recession is often backwards looking. So sometimes we don't, depending on the technical definition of the definition used for recession, like we get the next GDP print tomorrow, I believe it gets released. Sometimes we may be in, and historically, we may have been in a recession and not really know it. So to that point, you may be, we could be in one, you may not be in cash. And then second off, recessions, and I guess, correct me if I'm wrong, Chris, I think recessions on average typically last 9 months. So you get into that, going to the other question on how you miss the best days. If you go cash, say cash is king, recessions are often backwards looking. They don't last, they last maybe 3 quarters on average. You're trying to do that timing thing, and that's where that becomes an issue. So just to kind of add to that question, the comments.
Yeah, it sort of feeds into and then, I mean, we hear this, which is like, oh, I want things to improve and then I'll feel more comfortable moving back in. Well, that it's like, sell high, don't buy low, let it come back, and then it doesn't serve you results. And that's part of our job, is to guide your financial plan long term in terms of getting results. Okay. I don't see any additional questions here. I'll just come back to the very first page here. So again, we're going to be hosting these events quarterly. It will be the final Wednesday of each new quarter. You'll, of course, get an invitation to this. And so we'll have some consistency in terms of the event itself and in terms of the agenda. Of course, any questions you have, we're here to answer them. The other request was a copy of the presentation. Yes, I will send a copy of this presentation to each of you. I'll send it in a secure link, so you can download it. The link will be usable for a certain amount of time, I think 2 to 3 days, 72 hours maybe. So you'll be able to download the full presentation. I'm going to send it as a link so that the document is not too big. I can actually get it out to you. And that's it. I'm actually going to copy and paste it in the feedback. Please give us feedback. There's 7 questions. The type questions you don't have to answer. The sort of yes, no, single answer questions are required, but we want your feedback. So let us know what you think of the event, and we'll see you at the next one. Thanks so much. Bye-bye. All right, I'm going to stop sharing and stop the